I'm Adam Khoo, and I'm the founder of Wealth Academy, a trading investment school where we empower retail investors to profit like the professionals. And how do you trade as a professional trader? So in this video, this lesson, I'm going to be focusing on what it takes to truly be a consistently profitable trader. So whether you're a beginner who's losing money, or you've been trading for some time but you're not making money consistently, I believe that this lesson is going to show you the keys on how you can become a lot more profitable consistently. So what does it take to be a profitable trader? Well, it takes three things that have to work together. The first thing is you have got to have a trading system with a positive expectancy, or we call it a statistical edge in the market. So what it means is that if you keep trading over time, you will always make money. If you watch my previous video on trading like a casino, it's kind of like being a casino. That in the long run, the house always wins, the casino always wins because they have a statistical edge in the markets. So your trading system has to have that positive edge in the markets. So let's break it down. First and foremost, what is a trading system? A trading system is a specific set of entry and exit rules based on a sound methodology of how the markets work. Well, first and foremost, I can tell you that 90% of traders do not have a trading system, right? They buy and sell randomly, based on news or based on emotions or based on rumors for that matter, right? For example, they read that Warren Buffett's buying IBM, they go buy IBM. They are reading that this guru said that gold's going down, they are shorting gold. So if you don't have a consistent set of entry and exit rules, you can't make consistent profits and perform consistently. So what do I mean by a trading system? So here are a few examples of some simple trading systems that are pretty common, okay? One of them is a trend following swing trading system based on equities on daily candles. Now, this methodology is based on the fact that markets trend, stocks trend. For example, on an uptrend, it tends to continue going up, but on an uptrend, prices don't go up in a straight line. What happens is they will have an impulse, retrace, impulse, retrace, impulse, retrace. This is a methodology in the markets. And oftentimes when the price retraces, it tends to retrace to a moving average, which acts as a support level. So in this case, this swing trading system is based on a retracement to a moving average, like the 50 moving average. So for example, if you look at a very clear trending stock like AIS, you can see the impulse with a retracement, impulse, retracement, impulse, retracement. So once you see a repeatable pattern in the market, you can build a trading system around that pattern. But again, your entry and exit rules have to be consistent. So let's look at an example of that. So in this case, what are our entry rules for this trend following system? First, we want to see the 20 exponential moving average above the 50 moving average, which means the red line above the blue line, because this is an indication that the trend is a clear uptrend. Next, we want to see price retracing and testing the 50 moving average. In other words, hitting the 50 and bouncing off, where the 50 becomes a support level. So in this case, you can see the impulse, and it retraces and tests the 50. So that is the second criteria. The third criteria is we want to see the stochastics below 30, which means this full stochastics has to be below the 30 level. Because when it's below 30, it tells us that the price is temporarily oversold and it's due to bounce up. So there's a probability that it's going to bounce up and continue the uptrend. So once you have all these conditions that are met, you can put your buy order. So again, where do you buy? It's got to be a specific price, okay? So we place our buy entry 3 cents above the bullish candle. So in this case, after the price has bounced off the moving average, this is the first bullish candle we see. So we will place, according to our rules, our buy order or entry price 3 cents above that candle, which would be 36.50 in this case. Now, next question is, when do we exit? Again, it's going to be specific, right? In this case, we either exit with a loss or we exit with a profit. So we will place a stop loss order 3 cents below the swing low price. So where was the recent swing low during the retracement? It'd be somewhere over here. That's a swing low. So we place our stop loss 3 cents below the swing low. In this case, it would be 35.30. So this means our risk per share would be $1.20. So for every share we buy, if it hits our stop loss and it's a losing trade, we lose $1.20 per share. That's the maximum we can lose. So that's our maximum risk, hence R, our distance. Next, where do we exit with a profit? We'll place a take profit target at 2R above the entry price. So if we are risking 120, that's 1 hour distance. What's 2 hour distance? 240. So our take profit will be 240 plus 36.50. That will give us 38.90. So that's where we will exit with a profit. So this is what I call a very specific trading system. So when we enter the trade, there are only two outcomes. It either hits our stop loss where we lose $1.20 per share or 1 hour, or it hits our target price where we make $2.40 or 2 hour. In other words, we are risking $1 to make $2 for this system. Now, here's another example of a trading system. And this trading system is using a different methodology from the first one. The first one was based on trend following. We follow the trend. But markets don't trend all the time, right? There are times when markets go sideways, stocks go sideways. So when stocks go sideways, you find that stocks tend to revert around a mean. So this is known as a mean reversion swing trading system. So for example, if you take a look at Coca-Cola, this is a period of time when Coca-Cola is going sideways. So when the stock's going sideways and you're doing trend following, it's not going to really work. You got to use a mean reversion system. So one of the, again, a simple common trading system is one using Bollinger Bands, which is the upper band and the lower band. And an interesting repeatable price pattern you see is that prices tends to move between bands. So when it reaches the upper band, it tends to go down a bit. Upper band goes down, hits the lower band, goes up, upper band goes down, and it ding-dongs between the bands. So that's a repeatable price pattern. Again, we can build a trading system around that phenomenon. All right. So again, you need specific entry and exit rules. So here's an example of a trading system that utilizes this methodology. So the entry rule would be when the price touches the lower Bollinger Bands. So in this case, it has to touch the lower Bollinger Bands over here, and over here. Now, so that's the first condition. The second condition is when it touches or it goes out of the lower Bollinger Bands, we have to see a bullish reversal candlestick pattern. For example, like a bullish pin bar or a one white soldier or a morning star pattern that you can watch from my earlier videos. So in this case, you can see, does it meet that criteria? Yes, it does, because the price goes down, hits the lower Bollinger Bands, and we see a bullish pin bar over there. So that satisfies the two entry conditions. So where do we place our buy order? Again, specifically, we place our buy order 3 cents above the bullish reversal candle. So in this case, we'll place our buy order over there, 3 cents above that candle, $43.80 in this case. So that's where we enter. Now, where do we exit? Once again, always remember, in a trading system, you either exit with a profit or with a loss. So you're going to set a stop loss price. So we're going to set an exit price 3 cents below the reversal candle. which will be 3 cents below this candle. In this case, it will be 43.25. So what's the risk we are taking per share? So if we buy at 43.80 and it fails and hits our stop loss, we would lose 55 cents per share. That's the maximum amount we can lose per share. And that's our risk, or 1 hour distance. So next, where do we exit with a profit? We will put a profit target at 2 hour above the entry price. So once again, 1 hour is 55 cents. 2 hour would be $1.10. So our target price would be 43.80 plus $1.10. That would give us a target price of 44.90. So in other words, there are only 2 outcomes again. It either hits the target price. If the price goes up as we anticipate, we make $1.10. If it goes down and turns out to be a losing trade, we lose 55 cents or 1 hour. So here's an example of a trading system. I've shown you 2 fairly common trading systems, but understand that there are literally hundreds of trading systems used by different traders. And trading systems can be on different instruments. For example, there are trading systems on stocks, on forex, on options, and on futures. And there are trading systems that are based on scalping, which means your trade lasts for a couple of minutes and you look at 5 minutes or 1 minute candles. Your trading system could be based on day trading or intraday trading, where you're looking at hourly candles and you enter and exit within a day. Or it could be based on swing trading, where it's based on daily candles and your entry and exit happens over a couple of days. And within trading systems, you have got trend following systems and mean reversion systems, 2 different methodologies. So what's a trend following system? A trend following system is one where you buy with the trend or you sell the trend. So for example, on an uptrend, in this case, this is an uptrend. What you do, that's right, you buy on the uptrend. You buy when it retraces to a support level, and you buy before it continues the uptrend. So you enter over here and you may exit over there. That is a long trend following system. If it's on a downtrend like that, let's go down, retrace, down, retraces, and when it retraces to a resistance level, you would like to do a short sell and enter as it goes down. So you profit as it moves down. That's known as a trend following trading system. What's a mean reversion system? A mean reversion system could be one when the price goes sideways like that. It's going sideways, and what you do is you enter over there and you exit over there. Or you enter over here, you do a short and you exit over here and you cover your short. A mean reversion system could also be one when the price is on an uptrend, like this case, but it goes to a point when it goes overbought at the high of the uptrend. So you would do a short sell. So you would sell on the uptrend because you believe that it will revert to the mean of the trend. So you will enter over here, you do a short sell entry over here, and you would exit somewhere over here to buy back your short position to make a profit. Or if you see a downtrend in this case, but the price plunges and is oversold, what you do is you take a buy long position and you enter when it goes up, you exit, you sell for profit before it continues the downtrend. So this is what is known as counter trend trading. You're trading against the trend because it is a mean reversion system. So the point is, again, there are hundreds of trading systems and you have to choose one that fits your personality and fits your lifestyle. And that's one of the things that we do in our training programs. We teach you all these trading systems and we help you to find one that suits your personality and your lifestyle. Now, is having the right trading system important? Of course it is extremely important. Like I said, your trading system has to have a positive expectancy. But you know what? I can teach you my best trading system. You can learn the best trading systems from the best professional traders, but you could still end up losing money. because trading systems only make up 10% of your success. 30% of your success comes from correct position sizing or money management. So what's position sizing all about? It's about knowing how to calculate specifically how many shares to buy, or how many shares to sell, or how many contracts to buy or sell. It can't be based on your emotions or based on guesswork. It's got to be a mathematical formula. And in position sizing, you have to always consistently risk a small percentage of your capital. I repeat, you have to risk a small percentage of your capital consistently. And it's got to be between 1% to 3% of your capital. So why is this important? Because no matter how good your trading system is, no matter how good you are as a professional trader, you can't have winning trades all the time. It's impossible. It's kind of like you can't run a business without costs. You're going to have sales and costs that leads to profits, right? So let me give you a metaphor. In any business, you have got sales, you have got cost of goods sold, and sales minus cost would be, you got it right, profits. For example, if I have a shop and I'm selling clothes, selling t-shirts, right? And I'm selling a t-shirt for $10. Now it costs me $5 to make that t-shirt or to get it from a supplier. What's my profit? My profit's $5. Okay? Now as a professional trader, we look at trading as a business. So when we have a winning trade, that is kind of like our sales. When we have a losing trade, it's kind of like our cost of doing business. For example, in the previous trading systems I showed you, when we win 2R, right? When we lose 1R. We always risk 1 to make 2 or more. Why? So even if we are right half the time, for every win, if we have a loss, what happens? We are still making 1R in profit. So our profit margin is 50%, just like any other retail business. So here's the thing. If your trading system has a win rate of 60%, which is pretty good for a trading system, you have to be able to preserve your capital in the event of losing streaks which are inevitable. Why? Because in a trading system where your win rate is 60% or 50% for the matter, you will not always see a win and a loss and a win and a loss and a win and a loss. It doesn't always happen that way. Sometimes you could get a string of losses in a row. It's a fact of life. And sometimes you may also get, or you will also get, a string of wins in a row. And it is inevitable. So it's kind of like tossing a coin, right? So usually if you toss a coin, you get a heads and a tails and a heads and tails. But you will come to a point of time when you get a string of tails in a row. It will happen, or string of heads in a row. So when that happens, if you risk too much of your capital, you may get wiped out before the wins come about. So take a look at some statistics over here. You can see that if your trading system has a win rate of 50 to 60%, the probability of a losing streak is 12 to 16, which means that if you trade after a while, you will come a point of time when you get 12 to 16 losses in a row, or 12 to 16 wins in a row. So imagine, if you were to risk 10% of your capital on a trade, and you get 12 losses, guess what? You're wiped out. Game over, you can't trade anymore. And that is why we only risk 1% to a maximum of 3% for a trade. So even if we have a losing streak, it doesn't affect our capital very much. We preserve our capital so that when the winning streak comes, we make it all back and a whole lot more. So how do you size your positions, or how do you calculate the number of shares to buy so that you always risk the same percentage of your capital? Well, let me teach you the formula. So first and foremost, let's do a review. We always risk a fixed percentage of our capital for every single trade. So for example, you decide to risk 1% per trade, and we call that 1R. And again, R stands for risk. right? So when you have a losing trade, you lose 1% or you lose 1R. When you have a winning trade, you win 2% or more, right? 2R or more. So the formula to calculate the number of shares to buy would be as follows. You take your risk per trade, which would be 1% in this case, multiplied by your existing capital, and divide it by your risk per share, also known as your 1R distance. So this is your risk percentage, or also known as your R percentage, which in this case would be 1%, multiplied by your capital, which could be anything, for example, $10,000, 10 grand, divided by your risk per share. This would be a 1R distance, which is the distance from your entry price to your stop loss price, based on your trading system. So let's take a look at an example over here. So in this example, I'm buying a stock at $8.60 and I place a stop loss at $7.90. So again, how do I decide where to place my buy entry and where to place my stop loss? Well, this all depends on your trading system which you're using, and I gave you a few examples earlier on. Okay, so that's your buy entry, that's your stop loss. So what is your risk per share? Your risk per share would be 70 cents, or we call this your 1R distance. Next, where do we put our profit target? Well, your profit target has to be always at least more than 2 times your risk. So in this case, if we are risking 70 cents, we should aim to sell it at a profit of at least 140. So with this, we can then calculate the number of shares to buy. So let's use the formula. Let me draw it out for you. So first we take our risk per trade, which in this case is 1%. So 1% multiplied by our capital. Imagine your capital is $10,000, right? And you risk 1% of $10,000. What's 1% of $10,000? The answer is $100, right? So which means that in any trade you take, the maximum that you can lose is $100. Now, what is our risk per share? Our risk per share is 70 cents. So every share we buy, we are risking 70 cents. And we can afford to take a total of $100 of risk. So how many shares can we buy? Well, the answer is you take $100 divided by 70 cents. And that will give you 143 shares. So this means your position would be $8.60 multiplied by 143, which means you would buy $1,229 worth of Bank of America shares in this case. So is this the risk that you're taking? No, that is the position size. What is your risk? Your risk is $100. So understand that your position is not equals to your risk. This is your true risk which you're taking. So in other words, if it hits our stop loss, it turns out to be a losing trade, we will lose 1% of our capital or $100. If it hits our profit target, we will get 2% return on our capital or $200. Okay, so to continue with this lesson, please click on part 2 of this video and I'll see you on the next lesson.